Hello again, everyone, and this is our next installment in our Informational Tax Talk based on the new tax law that was passed in December of 2017, also known as the Tax Cut and Jobs Act. And today we're going to be talking about itemized deductions. In the last installment of the Informational Tax Talk, we talked about the standard deduction, how it's been increased for each filing status. Basically, the standard deduction has been doubled. And today we're going to talk about itemized deductions and the change to those itemized deductions. Itemized deductions will be the difference between those that don't use the standard and actually itemize. I'm going to basically concentrate on the changes in the itemized deductions under the new law. In prior law, at least for 2017, there was a 10% AGI limitation for any medical expenses that, I slipped off my chair there a little bit. There was a 10% limitation for 10% AGI limitation for any medical expenses. What that meant was in order to deduct any medical expenses, it had to exceed 10% of your adjusted gross income. Adjusted gross income is very different than taxable income. Adjusted gross income basically is your gross income minus any adjustments, like if you had, say, a student loan interest you could deduct, or you had alimony payments you paid out, or IRA deductions or something like that, that would adjust your gross income. So your AGI, you'll hear me refer to it as AGI. So under the new law, it's only a 7.5% limitation that you have to reach in order to claim medical expenses. Now, please understand, when I say in claiming medical expenses, it has to exceed 7.5% of your adjusted gross income. So for instance, if you made say $200,000, 7.5% of $200,000 is $14,500. That means you would have to spend that out of pocket. Okay, actually spend it either through a credit card or actual cash, writing checks or whatever, and it'd have to exceed $14,500 before you get an actual deduction. And as you can see, with 10%, it would have been $20,000. So that's one change there with the medical. The next big change is under the deduction for taxes. And when you itemize, you can deduct your income tax, your real estate taxes, your personal property tax, be it on your car, your boat, motorcycle, things of that nature, and of course, on your real estate, on your house, any local taxes that you pay in your particular jurisdiction. Now, under the new law, you can only deduct $10,000 aggregate in what they call SALT, and that's state and local taxes. Okay, so if your state and local taxes exceed $10,000, you lose the rest of it. And if you live in a state where the property taxes are high, then you could reach that $10,000 limit very quickly. Or if you make a certain amount of money, combined husband and wife, you could exceed that $10,000 limitation very quickly. And of course, you may have seen some of the political talk about states where there's high property tax or high income tax, they're going to lose the ability to fully deduct their taxes. Unfortunately, that is the case. But be mindful of that, because many people could run into that issue rather quickly, with that limitation being $10,000. The next big item under the new tax law, the Tax Cut and Jobs Act, is around the mortgage interest deduction. Okay, under the old law, you could deduct the interest on a mortgage of up to $1 million. Plus, you could deduct home equity interest. So if you borrowed money, you had equity in your house, and you borrowed money to buy a car, send the kids to college or whatever, or went on vacation, that interest was deductible. Under the new law, okay, the total combined mortgage is only $750,000. You can still do first and second residence, but the combination of those two, the debt can't exceed $750,000. The interest is only deductible on $750,000. And the interest has to be for acquisition or qualifying acquisition indebtedness, which means that the interest has to be to purchase, improve, or to use on the house. Basically, that's what it has to be. It can't be used for anything else. It has to be tied to the home, which means to purchase the home, to build the home, or to improve the home. Otherwise, the interest is not deductible. So in instance, say if you pay off your house, your primary mortgage, you pay it off and you go borrow money, and you don't use that money for in the house, you won't be able to deduct that interest at all. So be mindful of that in the new law. It's a big change. Now, also bear in mind this law only lasts for 8 years. Okay, so once the 8 years, if they don't do something, it'll all go back to the old way that it was. The next item that we'll talk about as far as a change is charitable contributions. Charitable contributions basically, and in a nutshell, you can deduct up to 50% of your income. Under the new law, you can deduct as much as 60% of your income as far as charitable contribution. And it's again, provided you're itemizing your deductions, you're not using the standard, because you have these itemized deductions that exceed whatever the standard would be for your particular filing status. So the charitable contributions has moved to 60%. Another big item that we want to be aware of is, and this was surprising to many of us in the field of preparing taxes, income taxes, was the fact that you can no longer deduct your unreimbursed employee business expenses, okay, the 2% limitation type of expenses. When I say 2% limitation, that means that this particular deduction had to exceed 2% of your adjusted gross income, or AGI. Now, if you were a salesperson working for someone and you traveled a lot, those deductions you would be able to take on your tax return if they weren't reimbursed. Under the new law, you will no longer be able to deduct those expenses, as well as your tax preparation fees. So if you paid someone to prepare your tax returns, those deductions will no longer be deductible. Those expenses, I should say, will no longer be deductible, as well as investment counseling. If you went to speak to a financial planner or someone of that nature, you could normally deduct that on your tax return, provided it exceeded 2% limitation. There you go, slipping again, excuse me. But you would no longer be able to deduct that item. So please keep that in mind. That's going to be huge for those of you that, wear uniforms, you clean them, you don't get reimbursed and things of that nature. You will no longer be able to claim those expenses. So you may want to begin to have a conversation with your employer to let them know that you can't deduct it on your tax return, so therefore it's becoming more expensive for you to carry out your job. So you may want to look at a better reimbursement arrangement and things of that nature. So there are some other items in there, but that's pretty much the biggest, the crux of the change in itemized deductions there. And so in our next installment, we're going to get into the change in the rates that's going to affect, and that's where we talk about taxable income and how much of your income will be taxed based on the change in rates. So until the next time, stay tuned. As always, you can get in contact with us by Maurice White, CPA. You can reach me at Maurice_W@msn.com. Reach out to us, or reach out to your own tax professional or someone in the income tax preparation community for additional information. But stay tuned, and we look forward to speaking with you again. Take care.